Will there be a housing crisis? The question of whether the world may be approaching another housing crisis is one that resurfaces every time interest rates rise, inflation pressures households, or home prices start to look disconnected from income levels. To understand if a crisis is likely, the strongest method is to examine the long-term indicators that have historically preceded housing downturns, compare the current data to the conditions that existed before the last major crisis, and evaluate whether the structural weaknesses that once caused deep global pain are present again or whether new factors could either prevent or trigger instability. Housing markets do not behave randomly. They follow patterns rooted in debt, affordability, supply, bank exposure, and the direction of monetary policy. When those factors align in the wrong way, the results can be severe. When they remain balanced, markets can cool without collapsing. The starting point for any serious analysis is the experience of the global housing crash that began in the late 2000s. In the United States, home prices have been rising for years, supported by cheap credit and widespread use of risky mortgages. According to the S&P Case-Shiller Home Price Index, U.S. home prices fell by around 27% from peak to bottom. That decline triggered a wave of financial stress because banks had packaged these mortgages into securities that were sold around the world. When defaults rose, the value of those securities fell sharply, leading to losses in the United States, the United Kingdom, and across the Eurozone. The US economy contracted by roughly 2.5%. Unemployment moved from around 4.5% to 10%. Millions of households faced foreclosure. That period is remembered as a defining global shock because the damage did not stop in one country. It spread through financial systems that were deeply interconnected. In the United Kingdom, the damage was substantial. UK housing prices fell by around 18% from peak to trough, based on data from major lenders such as Nationwide and Halifax. The UK economy contracted by more than 4%. Unemployment rose from around 5% to more than 8%. The country's financial sector had significant exposure to U.S. mortgage-backed securities, which magnified the losses. When global credit markets tightened, British banks reduced lending, construction slowed, and the broader economy weakened. Ireland experienced one of the harshest collapses. Irish home prices fell by roughly 50% according to the Central Statistics Office. That was the consequence of a housing boom supported by heavy construction activity, high household debt, and a banking system that relied on short-term international funding. When global credit froze, Ireland was among the first to feel the impact. GDP fell sharply, unemployment climbed into double digits, and the government intervened to support the financial system. Spain followed a similar pattern. Spanish home prices declined by about 30 to 35%. Unemployment rose dramatically, reaching around 18%. Construction activity, which had been a major driver of Spain's growth, collapsed. Japan's experience was different. While Japan did not have a major housing bubble leading into the crisis, its export-dependent economy suffered when global demand weakened. Japan's GDP contracted by more than 5%, showing that a global downturn can affect countries through trade even when domestic housing markets are stable. Australia and Canada, on the other hand, avoided severe declines. Australian home prices fell by around 5 to 7%. Canadian prices dipped but recovered relatively quickly. Both countries had stricter lending standards and less exposure to risky mortgage products, which insulated their financial systems. With that historical backdrop, the next question is how today's conditions compare. To determine whether a housing crisis is likely, analysts look closely at household debt levels, price-to-income ratios, mortgage structures, interest rate movements, supply constraints, wage growth, and banking stability. These indicators reveal whether markets are overheated or stable. One of the clearest parallels between the past and the present is the rise in price-to-income ratios in several countries. In some regions, home prices have grown faster than wages for many years. In the United States, the price-to-income ratio is elevated compared to long-term averages. In the United Kingdom and Canada, affordability has become a major issue, with price-to-income ratios significantly above levels seen before earlier housing cycles. Australia has also experienced long-term increases. High ratios do not automatically lead to a crisis, but they indicate that households are stretched. Stretched households are more vulnerable if interest rates rise or if the job market weakens. Household debt levels also provide clues. Before the last major crisis, US household debt reached record highs. In several countries today, debt levels remain elevated. Canada has one of the highest household debt-to-income ratios among major economies. Australia also has high levels of household borrowing. The United Kingdom has moderate but meaningful household debt. High debt increases the impact of interest rate changes because when borrowing costs rise, households with significant debt feel the pressure quickly. However, household debt dynamics are different today in some places. In the United States, tighter lending standards over the past decade mean that many borrowers currently hold fixed-rate mortgages with relatively low interest rates, which gives them stability even when central bank rates rise. Interest rates are a central factor in determining whether a housing crisis is likely. In the years leading to the last global downturn, interest rates were relatively low, encouraging borrowing. When stress appeared in the financial system, the challenge was not interest rates but credit quality. Today, interest rates have risen to levels not seen for many years in many economies. Higher interest rates increase the cost of borrowing for new buyers, slow demand, and place pressure on households with variable-rate mortgages. But interest rates alone do not cause a crisis. They can cool markets and reduce price growth without leading to widespread defaults. The risk emerges when higher rates collide with high debt, weak wage growth, or instability in employment. A fascinating factor today is the structure of mortgages. In the United States, the overwhelming majority of mortgages are fixed rate, often locked for periods as long as 30 years. This provides insulation. When central bank rates increase, the payments for existing homeowners do not change. This is a major difference from the conditions in several European markets, where variable-rate mortgages or short-term fixed periods are more common. In countries where large shares of borrowers hold adjustable-rate mortgages, rising interest rates can lead to increased monthly payments, reduced disposable income, and in some cases, financial stress. The United Kingdom has a mix of short fixed-rate periods, which means borrowers eventually move into a higher-rate environment at renewal. This can create pressure but does not automatically translate to a crisis unless unemployment rises significantly. Supply is another crucial factor. Before the last global collapse, countries like Spain and Ireland had built far more homes than demographic demand justified. Oversupply made the downturn deeper and longer. Today, many countries face the opposite problem: limited housing supply. In the United States, there has been a persistent shortage of new construction relative to population growth. In the United Kingdom, supply constraints have been a long-term issue. Canada and Australia face similar challenges. Undersupply can limit the severity of price declines because even when demand cools, the lack of available homes prevents sharp corrections unless there is a broad economic downturn. Another area analysts examine is the banking system. Before the last major downturn, financial institutions in several countries were exposed to risky mortgage-backed securities. When the value of those assets fell, banks faced losses that triggered a reduction in lending. Today, banking systems in many countries hold stronger capital positions and operate under stricter regulations. Stress testing is more common, and capital requirements are higher. While problems can still emerge, the system is generally more resilient, reducing the likelihood of widespread failures caused by housing weakness. While these structural improvements provide stability, it is important to understand the areas where risk remains. Some countries have high exposure to investment property purchases, which can be more sensitive to interest rate changes. In parts of Canada, a meaningful share of the housing market has been driven by investors, making it vulnerable if rental yields decline. In some regions of the United Kingdom, investor activity has also played a role. Investor-driven markets can experience sharper corrections because investors are more likely to sell quickly when returns fall. Another area that requires attention is the rental market. In countries where rental costs have risen faster than wages, households face financial strain even if they do not own a home. If rental markets weaken significantly, property owners with high leverage can experience reduced income, increasing financial risk. Conversely, strong rental markets can support housing prices by attracting investor demand. The rental landscape is therefore a key variable in overall housing stability. Interest rates deserve a deeper examination because they shape both demand and affordability. High interest rates reduce affordability and slow demand, but falling interest rates do not automatically guarantee stability. When interest rates fall sharply, it can indicate that central banks see economic weakness ahead. In several historical cases, falling interest rates were followed by recessions. This means that while lower rates can support borrowing, they can also reflect concerns about broader economic conditions. If lower rates coincide with job losses, wage stagnation, or declining confidence, housing markets can remain under pressure even as borrowing costs fall. The relationship between interest rates and housing stability is therefore more nuanced than it may appear. One of the strongest protections against a housing crisis is employment. During the last global downturn, unemployment rose sharply in multiple countries. When people lose their jobs, they struggle to make mortgage payments, demand for housing falls, and prices decline. Today, employment levels in many countries remain relatively strong. Wage growth varies across regions, but stable employment generally supports housing markets. A crisis is more likely when unemployment rises significantly and remains elevated for extended periods. Financial interconnectedness remains a factor, although the structure of global markets has evolved. Mortgage-backed securities are still used, but with stricter oversight. Banks continue to participate in global funding markets, but exposures to high-risk products have declined. While no system is immune to shocks, the financial architecture is more robust than it was before the last major downturn. To determine whether a housing crisis is likely, investors and policymakers monitor these indicators. High household debt, stretched affordability, weakening wage growth, elevated interest rates, construction downturns, and potential stress in the banking system are factors that require attention. However, the presence of these factors does not guarantee a crisis. Housing markets can adjust gradually through slower price growth, reduced transaction volumes, or moderate declines without entering crisis territory. The answer to whether there will be a housing crisis lies in the interaction of all these variables. A crisis becomes likely when multiple risks converge. When interest rates remain high, household debt is stretched, unemployment rises, supply exceeds demand, investor activity declines, and financial systems come under pressure. Today's conditions reflect a mix of both risk and resilience. Some markets exhibit vulnerabilities, while others remain well supported by strong fundamentals. The outcome will depend on how these forces evolve. For viewers who follow global housing trends and economic developments, it is essential to look beyond headlines and short-term fluctuations. The long-term data offers clarity. Affordability, debt levels, lending standards, supply and demand, interest rates, and financial system stability are the components that determine whether a housing downturn becomes a crisis or simply a period of adjustment. For more in-depth financial reporting, global market analysis, and data-driven commentary, remember to like and subscribe.